All right, let us look at this very question also and see how we can also go about it. All right, Body Limited is constructing residential building for its official staff. The company secured CTX loan of 200,000 at a cost of 12% on 31st January 2009. Any amount spent in excess of this loan is expected to be taken from the company's pool of funds. The following debts were outstanding as at 31st December 2009. 10% medium term loan, 500,000. 12% SCTX loan, 200,000. 5% backplace loan, 200,000. 7.5% long-term loan from TT Finance Service, 150,000. The 7.59 TT Finance loan was acquired in June 30th, 2009 to finance the construction of warehouse, which was expected to begin 1 year from the date of acquisition. The company earns 6% from investing temporary funds. The following expenses were incurred on the project during the first year of the construction. March 31st, 2009, 100,000 was paid. 30th April 2009, 50,000 was paid. And September 30th, 2009, 80,000 was paid. Now, determine borrowing cost to be capitalized and value of assets to be included in the PPE for the year ended 31st December 2009. So that is a question here. So how do we go about it? So when you look at this very question, it has component of what specific and borrowing cost, and then we have general borrowing cost. So how do we deal with this matter? What is the company name? The company name is what? Body Limited. Okay, so the Body Limited. So let's look at it. In the question, they said that. So they have what specific loan in the question, which is what CTX loan that they took, which is 200,000 to build what an asset at which were 12%. This is a question, and they said that fund the rest of the project, through what? Through general borrowing. Now, through general borrowing. Now, when you look at the general borrowing that they have outstanding, so the general borrowing that they have outstanding, they have what? They have what? 10% medium term loan, which is what? 500,000. They also have what? 12% CTX loan, which is what? 200,000. They have what? 5% backlist overdraft. I want to use what? 200,000. They also have 7.5% long-term loan. TT Finance, which is what? 150,000. Okay. So this is the nature of the question, and they also told them that they can what? Invest 6% of what? Invest 6% of temporary fund. Okay. Now, the project expenditure. So watch here. So they have 31st March 2009. How much was it? 100,000. 30th April 2009, 50,000. And then lastly, September 30th 2009, how much? 80,000. Now, solution. How do you go about it? Now, if you want to know total cost of a project, so when you find yourself in this very situation, and you want to know the actual, because here there's no actual, they didn't give you the total cost of the project. If you want to know the total cost of a, look at the project expenditure. So here, total project cost. You want to know the total project cost, and they are not specific. Look at the expenditure that they made over the period. So how much the expenditure, the total expenditure of a project starts from what? 100,000 plus 50,000 plus 80,000. So total of this, the expenditure, you can see it here. So this is the what? This is the total project what? Expenditure. Okay. So when you add all of them, it will give you how much? It will give you 230,000. So this is the total project expenditure. Now, when you read the question, you can see that the company took a specific loan from us, CTX, of how much? 200,000. So the loan, specific loan for the project was how much? 200,000 at 12% interest rate. So clearly, if the total project cost of 230,000 and they've taken what? 200,000 specific loan to start the project, clearly the specific loan will not complete the project. So you will have how much left, right? So you have how much? So here, and the question says that if you spend the specific loan of 200,000 project and it did not complete it, the rest or the balance should be taken from the general pool of funds. You can read it here. It is in there. You can see it here. They said that any amount spent in excess of this loan is expected to be taken from the company pool of funds. So that is, you are taking it from the pool of fund of what? Of the company. So here, when we look at this one, the specific loan is 200,000, but the total project cost is 230,000. So how much do you have left? You have 30,000 to what? Complete the project. So where do you get it? You get it from what? Pool of fund, which is what? The general borrowing, right? So where you will have what? The 230,000 minus 200,000. So the balance will have to be funded. The balance has to be funded through the what? Through the borrowing or general borrowing fund. So this is the summary of the question. So how do we deal with this now? First, you start with what? Specific loan. So the specific loan, you have what? The total loan is how much? You have loan, which is for 200,000. The rate is how much? 12%. How many months? How many months? Is it 12 months over the period? Or when you took the loan, when did you take the loan? You took the loan on 31st January 2009. And you are supposed to account for it as of 31st December 2009. That means how many months? 11 months. So if the loan was taken on what? The loan was taken on 31st January 2009. That means we've done 1 month for the year. So this one goes for 31st December. So how many months? 11 months. So you multiply 11 by 12. What is the specific interest on what? On the loan? All right, so the specific interest is what? 22,000. Now, in the question, they said that we should calculate what? Investment interest. The company invested the idle fund. So how do we determine the idle fund? What is the investment interest? So what this means is that, you see, the company attracted, so the loan acquired by the company. What was the loan acquired by the company? The loan was acquired on what? On 31st January 2009. And the company said that invest idle fund. How do they invest the idle fund? This loan was acquired at what? On 31st January 2009. And the loan payment, so the commencement or payment of the loan, first payment was made when? First payment was made on what? On 30th. First payment was made on 31st. First payment was made on 31st March 2009. That means if first payment was made on 31st March 2009, then that means the period between 31st January 2009 to 31st March 2009, the money was sitting idle. How many months? 2 months. So invest the money. You understand? Now, the money was sitting idle for all this while. So you invest the money. Now the second payment was what? Was made when? Second payment was made on 30th of April 2009, right? Now, if the second payment was made in 2nd April 2009, then look at it here. From 31st March 2009 to 30th April 2009, the money was also sitting idle. Part of the money was sitting idle. So it is how many months? 1 month. So the money was invested in 1 month, right? So between the first payment and second payment, there was some month the money was sitting idle. Then the third payment was when? The third payment was made on what? 30th of September 2009. Then that means between April, when the second payment was made, between April, which is 30th April 2009 to September 30th 2009, the money was also sitting idle. How many months? From April to September, 30th April to September is 5 months. So this is how we calculate for what? We calculate for our investment with interest. Now, when you look at the question, you will realize that, look at the expenditure, the payment expenditure. You look at the payment expenditure, you realize that the first payment was made in 31st March 2009, 100,000. So let's go into it properly. So here, you have it here. You have what your interest. How do you calculate the interest? You will have your so you have from 31st. So you pick it here, date. Now you have it from here, from between when the loan was acquired, 31st January 2009 to when the payment was made. The payment was made when? You see, the payment was made on 31st March 2009. So it means between when the loan was acquired. The loan was acquired on 31st January 2009 to the next, when was the loan payment made? The loan was paid on, sorry, the expenditure on the project was made on 31st March 2009. So how many months? It's 2 months. So here, how do we calculate for the interest? So here, this gives you the number of months. So the number of months is how many months? For 2 months in between. So how do we calculate the what? So you will have your what? Your rate here, which is 6%. They say we should invest it in 6 months. Sorry, invest in 6% interest. So here you will have your what? Your interest here. So how do you get it? So you have your what? The loan was what? Was 200,000, and then the interest on the loan was 6%, and we hold on to we invest the money for 2 months before the first payment was made. So when you calculate this, what do you have? You will have 2,000. Now the second payment, how did it go? So you have 2,000. So that means this money was what was invested. Let's go. So one was the second. So the second payment, the first payment was made, right? Okay. So first payment was made. So the payment was made when? The payment was made on 31st March 2009. That is when the payment was made. So how much was made? How much was made? When you look at the question, the first payment was made on what? 100,000. So 100,000. So how much was the total? The total was what? 200,000. And you made payment on 31st March, 100,000. So how much do you have left? You will have 100,000 left. And they say that invest this money on 31st March. Now, when you invest this money, what happens? You invested this money in March. So April, the next payment was made. So if April, the next payment, what do you do? You calculate again your interest. So how do you calculate your interest? You pick it when the investment was 31st March 2009 to the next payment was made on what? On 30th April 2009. How many months? That is 1 month. So you pick how much you invested, 100,000, multiply by 1 month, multiply by interest rate. How much do you have? What? 500. Okay, so this 500. Now, so in between this period, you have to attract this interest. Okay. Now, in the month of April, when the payment was made in what? In April, 30th April 2009. All right. So that payment, how much was made? Check. You will realize that 550,000 was made out of the money. So what do? You will come here. You will have 100,000 balance, which you invested. And in April, you have to make another payment, which is 50,000. So how much balance do you have? You have what? 50,000 left. You say invest this money also. So when you invested this money, what happened? They said that in September, a payment was also made in September. So what happened? 30th September, payment was made. So then between April to September, what happened? So you say 30th of April 2009 to what? 30th of September 2009. When we invested this 50,000, it's how many months? 5 months. So you pick this 50,000, multiply by how many months? 5 months. Times interest rate. How much do you have here? You have 250,000. So in September, that is when the project ends. So you will not invest. There's nothing available to invest again. When you are done, then you add all the money. What do you have? You have what? 3,750 being your what? Your interest so far. So this is the total interest that you accumulated over the period. All right. So when you are done, what do? I told you that because this falls under specific. As you invested the money, you will come here. This is your what? Your loan interest. Right? So this is a loan interest. So borrowing cost, loan interest. Then you will have your what? Your investment what? Your investment interest, which is how much? 3,750. So when you less it, whatever you have left is your what? Is your borrowing cost to be capitalized. All right, so your borrowing cost because how much is it? 18.2. So now we are done with what? With specific loan. Now let us go to general. The question says that we should what? Remember, I've already informed you in the earlier that if you want to know the total cost of the project, how do? You sum up all the what? You sum up all the payments that they've made over the what? Over the period. So here, when we look at it, you realize that they made first payment of what? 100,000 plus second payment was 50,000 and third payment was 80,000. When you sum all of it, you get 230,000. This is the total project cost. This is the total project cost. And in the question, they've told you also that they took specific loan for the what? For the project. Specific loan was how much? It was 200,000. And the question says that this 200,000 is for a project. If this 200,000 is not up to the total project expenses, then you should what? You should use you should take money from the general pool or pool of funds. So the pool of funds is general borrowing cost. So here, when you look at it, you realize that the total project is 230,000. Now you have the total specific loan to be 200,000. So it means the specific loan will not cannot complete. The loan cannot complete the project. So for that reason, you need to You need to pick the balance, right? So we have to pick the what? We have to pick the balance from the general pool. So when we look at it, we will have what? 300,000 what left what to be expended on the project. So where do we get this money from? We will take it from what? From the general pool of fund, right? So how do you go about? So you have this 30,000 what to go. So how do we calculate interest on this 30,000 that you want to take it from the pool of funds? So all you have to do is that you align all the general pool of fund. Now, which one forms the general pool? So let us look at it. 10% loan, 500,000. 12% XT loan, we know that one to be a specific loan. And then we have 5% back over the 200,000. and 7.5 from what TT Finance Service. And this money, TT Finance is what? Is loan acquired for something else. That one is also a specific loan for warehouse. So we cannot use this one because it's a specific loan for a warehouse. So we cannot use it for this project. So in that instance, if that's the case, then we can only have two general pool of fund, which is 10% medium term loan and 5% Barclays bank loan. Because 12% STX loan is a specific loan we know already. And then the 7.5% is also a specific loan for a warehouse. So if so, then we only have we are only left with only two general pool. So which is 10% Barclays. So how do you find that? So first you what? Let us weight it. So how do you weight? You pick the what? The loan, the rate, then the what? The interest. So how do we find them? The loan is what? 500,000 and the interest is what? 10%. So this gives what? 50,000. Then this one is what? 10% long-term loan, medium term. Okay. And then the other one is what? Barclays is 5% overdraft. Barclays overdraft. That one is how much? That one is 200,000. So 5% on this gives us how much? That gives me what? 100,000 or 10,000. Okay, so here give me what? 60,000 off. So this also give me what? 700,000. Okay. So now we can weight our interest. Weighted interest over 60,000 divided by what? 700,000 times 100%. Okay. All right. So that gives me what? 8.57% in all. Okay. So now that we know our weighted interest, how do we calculate our interest from the what? From expenses we made? So remember, when you are calculating interest from the general pool, you will calculate it based on the what? Based on the expenses or payment made. Now, when you look at this very question, you realize that the payments made so far have been with what? With the specific loan that we made the payment. So the balance that we will not get, we need to pay it through what? Through the general pool. So watch it here. When you look at it here, look at the payment. Look at the payment. The payment, first payment, let me put it this way. When you look at the first payment, this payment, 100,000 was first made through the specific loan. Because the specific loan was what? Was 200,000. So specific loan was 200,000, right? Specific loan was 200,000. So you can pay 100,000 from the specific loan. So when you pay, you have what? Specific loan was 200,000, and you pay 100,000 from it. How much do you have left? You have what? 100,000 left. Now, when you come to the second payment can also cover specific loan. So second payment, you have how much? You have 100,000. Specific, you have 100,000. So the 100,000, you what? You pay 50,000 from us from the 100,000. How much do you have left? You have 50,000 left. Now, the project 50,000 left. When you look at the final payment, you realize that how much left in the what? How much do we have left in the what? From the specific loan. We have 50,000. So here you'll have 50,000 here. Then you pay 80,000. So when you are paying the 80,000, you realize that this 80,000 cannot cover all the 50,000 left in the name of specific. So you realize that how much can the specific 50,000 cover? It can cover 50,000 out of 80,000. Now the 30,000 what will be from what? From the general pool, which is what? 30,000. Now how do we do it? So that the final 30,000 payment was funded in the what? In the last payment, which is on 30th September 2009. On the 30th September 2009. If so, when you come here, 30th September 2009? If so, then you will come here. How much are we going to pay? We are going to pay 30,000 left. Multiply by what? By 8%, 8.57%. Multiply by, because the last payment was made in September, where we are going to use part of general pool to add on to pay. Then so from we are accounting as at 31st December 2009. If so, from the day the payment was made to the end of the account year is how many months? 3 months. Well, from September, October, November. September is what, 30th. So October, November, December, 3 months, right? So that is it. So you have what? The last payment from this was what? One was on 30th September 2009 to 31st December 2009 is what? It's 3 months. So you have what? 3 over what? Over 12 here. So how much is it? That gives me 642.75. Alright, so this is the what? This is the interest from what? From the general borrowing. Alright, so when you are done, then what? You can sum up all the what? All the cost, borrowing costs, and so on. So yeah, when you pick your what? Your specific loan interest, which is net. Because the net, which is net, meaning I've deducted the what? The interest, investment interest, which gave me how much? How much do I have left? Here we are. It is here. Okay, so 18,250. So you have 18,250. Then you add the general pool interest, which is how much? 642.75. All right. So when you add it, when you sum it up, what do you have? So that gives me 1892.75. All right. All right. So there is what the interest what to be capitalized. So yeah, if you are capitalizing to know the total cost, total project cost, you have your what? Your project cost, which is 230,000. Then what? Then the interest, which is how much? 1892.75. What do we have? And what to give you? What? 24,8892.75. All right, that is it. Thank you very much.